All right, let's dive into one of the biggest questions in the startup world. We're talking about a real showdown, a battle for how early-stage companies get their first critical dollars. In one corner, you've got the old-school champion, convertible debt, and in the other, the modern challenger, the safe.
So picture this. You've got a world-changing idea, right? But it's just an idea. You have no revenue, no big track record. Your company is, in a very real sense, priceless. So how on earth do you and an investor agree on what it's worth? It's a huge puzzle, and for a long time, the answer was a pretty clever financial tool.
And that tool is called convertible debt. This was the go-to answer for decades. It was designed to do one thing really well: kick that tricky valuation question down the road so that startups could get the cash they needed to actually start building.
Now, at its core, it's pretty simple. It is a loan. An investor gives you money, and you promise to pay it back. But here's the twist. No one, and I mean no one, expects you to pay it back with cash. The entire point of this thing is for that loan to convert into ownership, into stock in your company at a later date.
So you might be asking, why would an investor do this? Why not just buy stock up front? Well, because they're taking a massive risk on you. So to reward them for that early belief, convertible debt has these key terms built right in to make sure they get a better deal than the investors who come in later.
The first reward is the discount. You can think of it like an early bird special. Because they got in on the ground floor, they get to buy their shares at a lower price than the big venture capital funds that will hopefully invest down the line.
And we're not talking about a small discount here. The industry standard, the most common number you'll see, is 20%. So if those future investors pay $1 a share, your first investor gets their shares for just 80 cents. That's a huge thank you for taking that initial leap of faith.
Okay, the second term is the valuation cap. And honestly, this is the big one. This is so important for investors. It basically sets a maximum price for their conversion, so if your company just takes off like a rocket ship, they're protected.
Let's make this real. An investor gives you $100,000 with a $5 million cap. A year later, you're crushing it and you raise more money at a $10 million valuation. Great, right? Well, the new investors buy in at that $10 million price. But your first investor? Their money converts as if the company was only worth $5 million. They literally get double the bang for their buck. That cap protects their upside.
And finally, we can't forget the debt part of convertible debt. Because it's a loan, it has an interest rate, usually around 8%. And it has a maturity date. This means there is a ticking clock, usually about 18 to 24 months. If you haven't raised your next round of funding by then, that loan comes due, and that puts a ton of pressure on a founder.
So, why did everyone use this for so long? Well, the logic was solid. It's way faster and cheaper than pricing a whole equity round from scratch. And, critically, it lets you sidestep that impossible valuation argument at the very beginning. It's supposed to be a bridge to get you to that next big milestone.
But it's definitely not perfect. Kicking the valuation can down the road can just make for a bigger fight later. That maturity date, it can feel like a ticking time bomb. And since it is legally a debt, things can get really messy if the company struggles. Even that valuation cap can sometimes accidentally set a low anchor for what your company is worth in the next round.
It was all these little downsides that led to a major innovation. Enter the SAFE, which was created by the legendary startup accelerator Y Combinator. It was specifically designed to keep all the good parts of convertible debt while just throwing out the bad stuff. SAFE stands for Simple Agreement for Future Equity, and the most important word there is agreement. This is the key difference. It is not a loan. It's simply a warrant. It's a promise that the investor will get stock in the future when you do raise a priced round.
The best way to think about a SAFE is that it's like a convertible note that went on a diet. It kept the core mechanics that investors love, it still has that discount, and it still has that all-important valuation cap. But it got rid of all the debt baggage. There's no interest, and most importantly, no maturity date.
For founders, you can see the appeal right away. It's crazy simple and fast. When you strip out the debt component, you get rid of that ticking clock. You get rid of the insolvency risks. It lets you just focus on building your company, not worrying about some financing deadline. But here's the thing. What's good for the founder isn't always good for the investor, right? By losing that debt structure, investors lose their legal protections if things go south. And without a maturity date, they have no leverage to force a conversation about getting their money back or converting their investment. It gives the founder a lot more control.
Okay, so this brings us to the main event. In one corner, the established, investor-friendly convertible debt. In the other, the newer, founder-friendly, safe. Let's put them side by side and see how they really stack up.
The difference is pretty stark when you lay it all out. The legal form, one's debt, one's not. It's that simple. Interest and a maturity date? Yes for convertible debt, no for a safe. For founders, the biggest risk with debt is actually defaulting. With a safe, the risk is a little more subtle. If you raise on too many of them, your ownership structure, your cap table, can get incredibly messy down the line.
So, which one should you choose? Honestly, there's no single right answer. It all comes down to what you, and just as importantly your investors, are trying to optimize for. Is it speed and simplicity, or is it protection and control?
You know, I love this analogy because it just cuts right to the chase. Convertible debt is a loan that comes with a bonus ticket to maybe get some stock. A safe, well, it throws away the loan and is just the ticket for the stock.
So you're probably going to lean toward a safe if you're a founder who just needs to move incredibly fast. You want to avoid that pressure cooker of a maturity date. The big if, of course, is that your investors have to be cool with giving up the safety net that comes with a traditional loan.
On the flip side, convertible debt is still very much alive and well, especially when investors want a bit more control. If your investor wants the legal protection of being a creditor, if they want a guaranteed interest return, and they want that maturity date to force a resolution, they're almost always going to push for a convertible note.
And that really leaves us with one last question to chew on. The safe was invented because convertible debt was seen as too slow and too complicated for today's startup world. But as the pace of everything just keeps getting faster and faster, are we going to need fundraising tools that are even simpler? It's a pretty fascinating question for the future of venture capital,